Well, welcome everybody. How many people are happy to be at the Aspen Ideas Festival? Okay. So I'm going to tell you how to pay for your tickets to the Aspen Ideas Festival, though they're very inexpensive. Basically what I wanted to talk about today, and thanks Kitty for arranging this on relatively short notice, is about investing. I have a new book coming out, which I'm not really promoting because it's not quite out yet, called How to Invest. And it's a book, and all the proceeds go to children's hospitals. So it's not any proceeds to me, not that you would be worried about that. But I tell you how I came to do this, and then I will tell you a little bit about the book and then answer some questions. But first, how many people here consider themselves to be serious professional investors? This is your livelihood, professional investing. Okay, well, you can leave because I'm not going to tell you anything you don't know. Okay. How many people consider yourselves to be not professional investors, but people that invest a little bit on deals you do yourself? You buy a piece of real estate or you buy some stocks yourself. Any people do that? Okay. How many people are pleased with the results from that? Okay, all right, good. How many people really know that they're not investors in the sense of they pick the stocks, they pick the real estate, but they pick funds or they pick other people to really do it for them? How many people do that? Okay. And how many people are students who would like to be professional investors at some point? Anybody here? Okay. So what I try to do is to write a book for all four of these audiences, which is almost impossible. But it's tried to give you a sense from each of these different backgrounds, some thoughts. And let me give you my own background, because I am not a professional investor in the sense that some people who are professional investors would consider it. As some of you may know, I'm trained as a lawyer. I went into politics. In the sense, I went to work in the White House with President Carter, where we got inflation as high as anybody's seen it up until almost recently. But my record has not yet been beat, and we were at 15 or 16% inflation rate, which we haven't yet gotten. Because I got inflation so high, I had to leave the government when we lost the election in 1980. I'll never forget telling President Carter, look, Ronald Reagan is an old man. He's 69 years old. Nobody that old can get out of bed in the morning, let alone run for president. I'm 72 now, so 69 seems like a teenager to me. But we lost, and I had to go back and practice law, again, unsuccessfully. Nobody wanted me to be their lawyer for good reason. And so I ultimately started Carlyle, and I was not trained as an investor. And Carlyle today is a firm that manages about $375 billion, so it's a large private equity firm. I was not honestly the professional investor there. I did the fundraising, the recruiting, the strategy, and other public kind of things. I had some partners that actually knew how to invest, and so I sat in several thousand investment committees. People didn't really listen to my advice probably, but I sat in the committees, I absorbed a bit, and I serve on a lot of investment committees now at nonprofits. So I've been thinking about investing for a while, but I wouldn't say that Warren Buffett is going to call me a professional investor. I did interview Warren Buffett a number of times, and I learned a fair bit about it, and I actually dedicated my book to Warren Buffett and to my two partners who helped me start Carlyle. And in thinking about interviewing Warren Buffett after many, many times of doing so, I said, okay, what is it that he did that made him so great, and what makes a great investor great? And so I decided I would go out and use a technique some of you know I use, which is to interview people. So I spent about 2 years interviewing the best investors in the United States. I decided not to go around the world. It was too complicated. So I did the best investors in the United States. And I will tell you about some of them. Then I'll tell you some of the lessons that I got from them and how it all kind of comes together in my view. But think about this at the outset. All of life is really about figuring out how to deal with the future. Should I marry this person? Should I go to this school? Should I have this career? What will the future be for me? And everybody's trying to guess what is going to be best for themselves with respect to what's going to happen in the future. Should I marry this person? Is this person as good as he or she seems? You never know. Sometimes they are, sometimes they aren't. Is this career as good as it seems? Maybe it is, maybe it isn't. Is this the right school for me? All of you know a lot of these. You've made these decisions. Everybody here has made these decisions. Should you marry this person? Should you go to this school? Should you have this career? And you're guessing about the future, and sometimes you guess right, and sometimes you guess wrong. There's no perfect way to measure whether you have made right decisions about your assessment of the future. Investors are the same thing. They are measuring the future, where the companies are going to go, where the economy is going to go, that there's a difference between what you do in life generally, and what I do in life, about guessing the future, and what investors do. Investors are measured very precisely. Every day they can see in the newspapers, or if it's a private equity kind of thing, eventually they'll see the numbers. And in investing, you're trying to guess the future, and you're trying to figure out where the world's going to go, and how do I get there and get the best results for myself. And we measure it by profitability. The goal in generally investing is to be profitable and make investments. And some people make good investments, some people make bad investments, some people are good at guessing the future. In my life, I made some good bets about where I should do in life, made some bad bets. I've made some good bets in the future about investing, some bad bets. But basically, it's all about guessing the future. And nobody's perfect at it. But for better or worse, in the investing world, you get to measure how your guess is in the future pretty precisely, because we use numbers and we have profitability and earnings and so forth. So what I tried to do is to figure out what are the basic categories of investing. And I divide it into three categories, what I'll call core. And core or mainstream. Throughout the history of the world, people who, when they had extra money, what did they usually do with it? Well, initially they probably put it in cash, and they kept it, if there was cash, put it under a mattress, let's say. But then eventually people began to maybe buy some real estate, or that they would buy some bonds, or then eventually they would buy stocks. And so the core part of investing historically has been people owning their own real estate, then buy some more real estate, core real estate with a modest rate of return, or they would then give some money to a bank for just a modest return, that's a cash-related interest rate return, or they would buy bonds with higher rates of return, or they eventually would buy stocks. And those are what people today would call mainstream. And those were the things that most people for hundreds of years in the United States and in Europe would invest in. And the rates of return vary, but as a general rule of thumb, if you put your money in a bank historically, leaving aside inflation now, you might get 1%, maybe 2%, something like that. Not right now, but that's historically it. If you put your money in bonds, historically you get 2 or 3%, maybe 4%, some corporate bonds. Historically, obviously, there's higher yield bonds and so forth. And equity markets, over the last 100 years or so, the S&P 500 has been averaging about 6%. So if you put your money in equities, you're probably going to get about 6%. So put your money in a bank, put your money in bonds, put your money in equities, you get varying returns. After World War II, a new category came along we now call alternatives, where people coming back from World War II started setting up venture funds, and hedge funds were set up, and then private equity funds. And they had a novel concept, which was, we're going to add value. We're not just picking stocks, but what we're going to do is we're going to add so much value by going on the boards or really doing things to help the companies that we want more than just a little fee. We want a piece of the profits, 20%, now known as the famous carried interest. And that whole business has developed over the last 30 years or so, 40 years or so. So now what's called alternative, as opposed to mainstream, is private equity, which buyouts, some people would say, venture capital, growth capital, hedge funds, distressed debt, opportunistic real estate, which is a different type of real estate. So that's what we would call alternatives, and we historically call them alternatives. And interestingly, people in the United States were not allowed, as a fiduciary, to invest in these alternatives for a long time. In the Carter administration, I had nothing to do with it. In 1978, the Department of Labor said it's okay for ERISA funds to finally invest in alternatives, which would be the kind of things I mentioned, buyouts or venture capital. It was thought originally to be too risky. Now, alternatives are thought to be essential if you're going to have a portfolio, because the returns over the last 5 years, 10 years, 15 years, 20 years, 25 years, 30 years, 40 years, for alternatives have outperformed public market indices by almost 200 to 400 basis points on average, something like that. So basically, more and more people put their money in these so-called alternatives. And then I have a third category, which I've labeled, it's kind of newer categories, something that I would call not mainstream and not alternative, but something that's newer and probably more risky. And I put in there cryptocurrencies, SPACs, infrastructure, and ESG-related investments. And I talk to people in those categories as well. So throughout all those categories, I interviewed some of the best people. And let me tell you some of the people I interviewed. I won't go through all their names, all their backgrounds, but they're very interesting people, and they all have similarities and backgrounds. Great investors have a lot in common. People who are great in any category, architects, lawyers, baseball players, are all going to have certain things in common. And what I found in common for the great investors was they tended to come from I'd say blue-collar families to middle-income families. They were not from wealthy families. They tended to not be obsessed with investing. Warren Buffett is an exception, not to be obsessed with investing from a young age. They were actually interested in other things. They tended to be pretty good students, not the superstar students, but pretty good students. They tended to have a pretty good feel for math. They tended to have a ability to really absorb a lot of information. And great investors, you can't give them too much information. They really want to know almost everything you can possibly know about any subject. They just have an incredible quest for knowledge, and because they always think that something will come along that will maybe use that knowledge. They also tend to be fairly control-oriented. They like to make the final decision. They don't like to delegate it. They also tend to go into detail a great deal on the investments that they're really obsessed with, and they really learn all the details of it. They tend to be very hard workers. They tend not to be people that are not hard workers. They tend to be people who are, I would say in the end, fairly philanthropic. Obviously, most professions are not designed for the sole purpose of making money. If you want to be a lawyer, you maybe want to represent people, you want to be a doctor, you want to help people in certain ways. If you are investing, you're basically trying to make money. Now, you can say you're going to do it for a good social purpose, and I'll describe why I think it's a good social purpose, but basically, in the end, you're trying to make money by being an investor, and ultimately, what investors do who are successful is they give away the money. Almost all of the great investors are extremely philanthropic, as you would expect. They have a lot of money, and they're quite philanthropic in what they do. I would say that it's not easy to predict who's going to be a great investor from the outset. Some people have different backgrounds. They are not easily predictable. Some have failed a fair bit in their past and actually got out of the business they were in and gone into a different business. Some people have succeeded in one business, went to another business, and succeeded even more there. But you can't always predict who's going to be a great investor. I'd say humility is sometimes there with some great investors, sometimes not. They're pretty good at pretending they're humble, but they're, if you're made billions of dollars as an investor, you probably are not going to be that humble. So who are some of the people I talked to? Let's go through some of the first categories. So in stocks, of course, Warren Buffett's been doing that for a long time, and I didn't interview him. As I said, I've already interviewed him and published some interviews with him, but I talked to other people, and let me mention today probably a guy who does a lot of stock buying. I don't know if you would consider him a great investor, but probably the most influential investor in many ways in the world today is a guy named Larry Fink. Larry Fink was a bond investor or bond trader at First Boston, got fired for losing $100 million one year in his group, and got fired. So he was out, basically, and started a little firm that later became BlackRock. And now they manage roughly $10 trillion. And they probably have more impact on the investing world than anything else, and they own more stocks than any other single company in the world. And so, you could argue he's the biggest investor, the most influential investor. He wouldn't consider himself that, but his firm has become the biggest investor in the stock market and also in index markets and so forth. Another person I interviewed was a guy named Ron Barron. Some of you may have heard of Ron Barron. He was a person who emulated Warren Buffett. He's a lawyer by training, but started a firm called Barron Funds, and basically has an approach exactly like Warren Buffett's, which is to buy a company and basically hold on it almost forever. But he likes companies where the owners are very, very involved, and basically he sticks through them through thick and thin, and he turned out to be a very obsessed with Elon Musk, and so he was an early investor in Elon Musk's company, Tesla, and also SpaceX, and made a fortune doing that. And basically, but he runs a business that's very unusual. Today, if you want to buy stocks, you can pick them yourself, but generally people who buy stocks today are buying index funds because the theory is you're not going to be able to beat the market. Now, some people can beat the market rarely, but they can. But as a general rule of thumb, people have been convinced today that the best thing to do with your money if you're going to buy equities is to buy index funds and more or less go along with the market. The fees are very small. He has a mutual fund, Ron Barron, and it basically charges the kind of fees the mutual funds charge, which are much higher than the so-called index funds or ETF funds. And he's beaten the market on average by 500 basis points per year since the 30 years he's been doing it. And he does it with techniques he uses, but he's pretty good and is a very, very smart investor. In terms of fixed income, today there are many great fixed income investors, and I interviewed a number of them, but one I did was in a category that I won't really call quite core, but it's a debt-related one, and fixed income one. It's called distressed debt. And I interviewed Bruce Karsh, who with Howard Marks started Oaktree, and they have become probably the most successful of the distressed debt investors. And for those who don't know what distressed debt is, when a buyout is done, sometimes it doesn't work out. The debt that's worth 100 cents on a dollar initially becomes worth less, and they buy it at a discount, and ultimately they make greater returns than you would get actually in equity. So it's spectacular rates of return. I also interviewed people who do something today that's very important. They manage endowments. And and it used to be the case that endowments were not that significant in the United States. In 1900, Harvard's endowment was about $5 million. Yale was maybe $10 million. Because in those days, endowments were not considered a big thing. People paid their way to college through tuition. Tuition paid everything. After World War II, as we had GIs coming back, colleges started expanding. They needed more money. They began raising endowments. Endowments began to invest in equities. And then later, at Yale, they invented the idea of investing in alternatives in a dramatic way. David Swensen did that. And as a result, colleges that have these gigantic endowments now, Harvard's is over $50 billion, Yale and Stanford is over $30 billion. Well, people who do these endowment investing, they're very, very interesting people. The most famous of them is a man I couldn't interview. He passed away just before the interview, David Swensen. He was a person who was given the mandate at the age of 31 to invest the Yale endowment. And he basically came up with a pioneering way of investing in alternatives, which is to pick young funds and be there at the beginning with them, lower fees and so forth, and a bigger ability to get co-investment from them. And he basically revolutionized investing in endowments. And now a lot of his, I would say his proteges are now investing in endowments around the country. One of my interviewed is a woman, some of you may have seen, I interviewed her on TV recently. Her name is Paula Volent. And she's an interesting person. She was trained as an art conservator. And that she was, basically an art conservator and was working in the National Gallery of Art and other places. And then she decided she was building a little business in art conservation. So what did she do? She said, I need to go learn more about business. So she went to Yale School of Management. While she was there, she wandered into David Swensen's office and said, I'd like to learn more about what you do. And he kind of gave her some filing jobs. And eventually he used her to help write his new book. And then eventually he helped her get a job where she became the head of the endowment at Bowdoin, a small college in Maine. And at that time, the Bowdoin endowment was very small, and she helped improve it so much so that for the last 20 years, the 20 years she was managing it, she outperformed David Swensen. And in fact, for the last 10 years, she was running the Bowdoin endowment. She outperformed the Ivy League, every single Ivy League college endowment. And so she was a star. She's now running the endowment for Rockefeller University. But there's a person who didn't have an investment background particularly, but trained by a master and did quite well. I would say in the alternative category, there are a lot of people I interviewed. Let me mention a couple in the hedge fund world. I interviewed a person named Ray Dalio. Ray Dalio built the biggest single hedge fund in the world. He started it 50 years ago. Most hedge funds come and go because in the hedge fund world, the way it's structured, if you do poorly for a couple years, you can't get back to the mark, to the high water mark, you probably go out of business. And so many of the hedge funds don't last that long because they do well for 3, 4, 5, 6, 7 years, and then maybe they have a bad year or two, and then they go out of business, become a family office, whatever you want to call it. Ray Dalio has for 50 years been running this fund. It's the biggest one, Bridgewater. He's got now about $150 billion, which is a big fund for sure, and he's got a great track record. But he didn't start out so spectacularly. He barely got through high school, barely got into a college. He did do well in college, went to Harvard Business School, but he basically wanted to invest in commodities. He got a job in the commodities area. One night he went out drinking with his boss, punched him in the face, got fired, and had to start all over again. And ultimately he became pretty knowledgeable about certain parts of life, and he's written a book some of you may have heard about, Principles. He's run his company based on certain principles, and he's really a real, I would say, Renaissance man because he's really, really thoughtful about global economic issues, but he's built the biggest hedge fund in the world. Another hedge fund person that I interviewed, well, I've interviewed a number of hedge fund guys, but one person I interviewed was John Paulson. Some of you may have heard of him. John Paulson made the single greatest investment decision of any investor I've met in one decision. He shorted in effect, the mortgage market right around the time of the Great Recession was coming about. He thought that the mortgages, particularly subprime mortgages, were going to default, and so he basically made an incredibly elaborate bet, bigger than anybody ever made, on shorting the credit market and the mortgage market. He made in one trade roughly $20 billion, and nobody's ever done that before. So it's pretty impressive. But John Paulson is I guess, probably made the greatest single trade. Prior to that, one of the best trades was made by a guy named Stan Druckenmiller, who I interviewed. Stan Druckenmiller was helping to run George Soros' fund. And while he was with George Soros about 25 years ago or so now, or maybe 30 years ago, they made a bet that the British pound would basically not hold its value, and that it was basically linked with the Deutsche Mark, and basically was thought by Stan Druckenmiller that it would go down. He shorted the pound, made $1 billion, which was the biggest profit anybody ever made in a trade at that time. It was a very famous trade. Stan Druckenmiller, somebody interviewed, a brilliant man who also didn't start out wanting to be an investor. He actually, was going to be an economist, didn't quite like economics, and dropped out of a PhD program. He then built his own fund in Pittsburgh. Then Soros heard about him. Soros had him managing his fund for many, many years. Then he has his own fund now. And he's considered, I'd say, one of the best investors in the world. And he actually is the chairman of the Bowdoin endowment. So he was really helping Paula Volent as well. So she had two great mentors. I also interviewed a person you probably haven't heard of in the buyout world. A man named, you've heard of the famous buyout people, the Henry Kravises and Steve Schwartzmans and so forth, and they've done very well. I didn't interview them. I wanted to have some different faces, so I interviewed a person named Orlando Bravo, which is a wonderful name, last name. I mean, his investors were always saying Bravo because of his returns. Orlando Bravo grew up in Puerto Rico, and he wanted to be a tennis player. And in fact, he went to tennis camp in Florida with Nick Bollettieri's tennis camp, and he basically roomed with Andre Agassi and played with him a fair bit. He realized Agassi was maybe a little bit better, so he decided he wouldn't become the tennis pro he once thought. He went to Brown, played tennis there, then to the Stanford Business School, Stanford Law School, and then he decided to get into the buyout world, and he decided to specialize in an area called enterprise software, which means this kind of software that can help run a company. And he's done so well in building his firm that recently, during COVID, for over a 1 year period of time, when you couldn't really go out and raise money or anything in person, he raised about $25 billion just on Zoom calls because his track record was over 30% per annum. And he had a spectacular track record. He's not as well known yet, but he is now one of the richest investors in the country and done spectacularly well, giving back to his native Puerto Rico and a lot of the challenges they have. I also interviewed in some of the new categories that I mentioned, opportunistic real estate. I interviewed John Gray. Some of you probably know him. John Gray was a University of Pennsylvania graduate, not particularly business-oriented. He had actually gone to Wharton undergrad, but he also gone to liberal arts. Went to work at Blackstone doing M&A and so forth. And Blackstone was thinking maybe they should buy something in real estate. They asked him to help out a little bit. And in the end, he liked it, and they said, we're going to start a real estate group. John, would you like to go in it? And John went in it, and then he did two of the greatest real estate deals of all time. He basically bought the biggest office building company in the United States, owned by Sam Zell, who I also interviewed for the book. And John Gray bought this at $39 billion. And then right before the market crashed, this was probably worth about maybe $20 billion. But he cleverly pre-sold many of the things, and they made billions of dollars of profits for Blackstone. Those who bought the things from John Gray didn't do as well, but John Gray made a spectacular fortune for Blackstone. They then bought, with John Gray's leadership, Hilton, which was more or less a real estate deal. They made the biggest profit of any buyout they've ever done, $14 billion. So John Gray now not only built the greatest real estate business in the world for Blackstone, but he also now is the president of Blackstone. So very clever, very smart guy, and very easygoing, and very likable person. I also interviewed Sam Zell. Some of you may know Sam Zell. Sam Zell is, he calls himself the grave dancer. He likes to dance on the graves of other people's failed deals, and he's very good at it. I just interviewed him again for a television show the other day. And, he's in his, I think, early 80s now, and he's riding motorcycles around the world at record-breaking speeds. But he's really, really a talented guy in figuring out how to negotiate something and buy real estate. And he's the kind of guy you don't picture reading 300-page memos. Very smart, but he has great gut instincts. And that's kind of what Warren Buffett has and what Sam Zell and some of the other people have. In my firm, when we make an investment decision, it's typically based on a 300-page memo that some young people have come up with. And we read the memo, but in the end, who can really predict what the rate of return is going to be 20 years down the road or 10 years down the road? And these young MBAs prepare these memos. I don't know how valuable they are. The great investors really rely on their instincts. And really, the greatest attribute that a great investor has that makes him or her great is that they're willing to go against conventional wisdom. Because if you just go along with conventional wisdom, you'll be along with the pack. So the single most important thing that great investors have is they're willing to buck the conventional wisdom and go where other people aren't willing to go. And in some cases, I interviewed some people who are in that category now for some of the newer kinds of things to illustrate. There's a person named David Blood. Some of you may have heard of him. He was the head of asset management at Goldman Sachs. He didn't want the firm to go public. They went public over his objection. He eventually left. And he was thinking about what to do. And he believed that companies have more of a responsibility than just making profit. And he was thinking about what to do. And a guy who was thinking about making an investment in companies that were doing good things in the environmental area was named Al Gore. And Al Gore and David Blood got together. And they formed a company called Generation Investment Management. And it's focused only on investing in companies that have really good ESG. And they've now had the company going for, I guess, maybe 15 years or so, and they have outperformed the public markets by 300, 400 basis points. The firm is, of course, affectionately known as Blood and Gore, but it shows you can go against the conventional wisdom. The conventional wisdom was if you invest in things that worry about ESG, which is to say environmental, social governance, and good governance, and social responsibility, ESG, you're probably going to have a lower rate of return. That's the conventional wisdom. But they actually showed you can get a higher rate of return if you really know what you're doing and invest in that area. Another area recently is cryptocurrencies. Crypto has had a tough May, I'd say, and probably hasn't been great for a while. But if you bought crypto at 50 cents per Bitcoin, you probably are still okay. So I interviewed a man named Mike Novogratz. Some of you may have heard of him. He was a Goldman partner and ultimately a trader, and ultimately left Goldman, started Fortress, which was a pretty good trading firm. He left that, and he got a bug about buying cryptocurrencies. And he bought more, I think, Bitcoin than virtually anybody. At one point, it was probably worth about $10 billion of Bitcoin, which he probably put in about $8 million or so to get. It's obviously gone down in value a lot, but still, he's got billions of dollars of Bitcoin and other cryptocurrencies, and he's a big believer in it. And his argument is that a lot of younger people don't believe in government currencies. They think that's been devalued and deflated and so forth, or inflated, and therefore he thinks eventually you're going to see more and more cryptocurrencies. Some will be better than others, but you know it's a novel kind of concept, and that's going against the grain kind of idea. Another idea that somebody came up with that's not completely against the grain, but you wouldn't have thought of as a new kind of investment. It's called infrastructure. Historically, in the United States, infrastructure has been built by governments, so airports, bridges, roads, so forth. A number of years ago in Australia, some groups started buying airports, and they made a lot of profit on it. And so the idea kind of came to the United States and Europe that you could buy airports from government entities, you could buy bridges, toll roads, or you could build these things, and ultimately you'd get a very good rate of return, predictable rate of return, not as high as private equity or venture capital, but reasonably good. And my own firm went into this area as well, because the reason people like this kind of investment is if you're, let's say you own the New Jersey Turnpike, you're going to get a very predictable rate of return and so forth, and it can go on for a very long time. So investors like this because they're going to get a very predictable, solid rate of return and for a very long time. And so this business has grown dramatically in the United States. Now there's roughly, I think, about $12 trillion committed to it. And this is a business with now all over the world. Brownfield ones where you're buying existing bridges, toll roads, airports, or greenfield where you're buying new ones. The person who's built the biggest one in the world is somebody that I knew quite well. And when I was trying to build a firm, a business in Carlyle for infrastructure, I called him up. He's a Nigerian who went to Harvard Business School, Harvard Law School, very smart. He was practicing law in New York, went to Credit Suisse. He was the head of investment banking. He decided to leave and set up an infrastructure fund backed by General Electric and Credit Suisse. And I called him just as he about committed to do that, so I couldn't get him to join my firm. But he built a business now that has about $90 billion committed in infrastructure all over the world, and built airports and revised airport. It's going to be a very good business still in the future. Another area that I should have mentioned is an alternative is venture capital. Venture capital was very hot for a while, and I interviewed a person who had a really unusual background. He was born in Wales, and he's Jewish. Now, how many Jews do you think there are in Wales? Probably not that many. His parents were Holocaust refugees. They settled in Wales because that's where they got visas, I guess. There are about I think he told me there were about 800 families of Jewish in Wales at the time he was growing up. And he, a smart guy, went to Oxford. His name is Michael Moritz. And he then came to the United States, went to Wharton, got an MBA, but he became a journalist. And he was basically one of the senior correspondents at Time. He was writing a story on Steve Jobs, and making Steve Jobs was going to be the story, was going to be Man of the Year the editors at time made it into the computer of the year, or machine of the year, which Steve Jobs didn't like, and Michael Moritz didn't like it either, so he left. And he actually went to a firm that was a pretty good firm, but not the most famous firm in Silicon Valley, and he convinced them to hire a journalist to join a firm. And that firm is Sequoia. And Sequoia is today probably the most profitable of the great venture firms. They have been staggering in their investments in companies like Google, early investor in Google, early investor in, I almost say Facebook, other kinds of things. So they've made a staggering amount of money, and he has become probably about the wealthiest person in the venture capital world. John Doerr, I saw him here, I don't know if he's here now. John Doerr, I saw him a couple of days ago. He's also, I didn't interview him for this book, I'm interviewing for my TV show in a couple of weeks, but he's also one of the guys who helped build the venture capital business. And the venture capital world has been booming in the last couple of years, obviously some decline in recent months or so, but still an incredible business. I also interviewed Mark Andreessen. Mark Andreessen is a very interesting person. He came to my office when he graduated from college. And he was with a man who had built a company called Silicon Graphics. His name was Jim Clark. And they came to my office, and I think it was probably in the maybe early 90s or something, mid-90s, something like that. And Jim had been a very, very successful guy running Silicon Graphics. He was a professor at Stanford, Jim Clark. And he had this young guy with jeans on and long hair. And he said, this guy and he were starting a company together. And the company was going to navigate the internet. And I said, well, why would I want, what is the internet and why would I want to navigate it? What is it? We didn't know. And he said, well, it's a way to kind of learn more information. You can learn all kinds of things. We said, well, I'm not sure. He said, you should invest in this company. It's going to be worth, we're going to value it at the beginning at $100 million. I said, wait a second. We're smart guys. You've got no revenue. You got this college kid. You're going to navigate the internet. Nobody knows what it is. And you want us to value it at $100 million? There's the door. So he left. He came back at a lower valuation a couple weeks later. We said, look, it's no better at 75 million than it was 100. So we turned it down again. That became Netscape. And Netscape was sold to AOL for 4.2 billion, one of my mistakes. But then ultimately, Mark Andreessen left AOL. He started another company in Silicon Valley, sold it to Hewlett-Packard for $1 billion. Then he started his own firm called Andreessen Horowitz. And now it's become one of the leading venture firms in Silicon Valley. And he's also an example of a person who really, really is a focused investor and really understands technology and built one of the great venture firms, I'd say just in the last 10 years or so. Another person I interviewed is some people who invented a new type of investing. And some of you may have heard of him, some of you may not. This is a man who grew up in the Boston area, went to MIT, math star, very good, in fact, a really good math star, got a PhD at Berkeley in math, and then became the head of a major university's math department at the age of 30. Really talented at this, but then he decided he just was getting a little bored with it and decided to start something new. And he started the idea of using math skills to invest. And he invented more or less quantitative investing. And his name is Jim Simons. And some of you may have heard of him. He's built probably the most successful of all the venture firms, or hedge funds, I should say, in the last 40 years. In the last, I'd say 30 years or so, he's averaged 40% a year on his internal fund. He has an internal fund for employees and other friends. Averaged 40% a year for 30 years, which is pretty good. And he's also quite iconoclastic. I knew him because I'm on the board of the Institute for Advanced Study, which is where Albert Einstein taught for a while. And Jim, also like Albert Einstein, never wears socks, never. So I interviewed him at a black tie dinner where he got the Einstein Award, but he had his black tie on and no socks. And so I've concluded, as I said in the interview, that maybe not wearing socks is one of the keys to being a good investor. I don't know, but try that out. But he's a man who has also become extremely philanthropic, but a brilliant investor, but more or less invented the idea that hadn't existed before. It had always been thought that humans are smarter than anything else, and humans can be smarter than machines. But now we realize in certain areas, in public securities, commodities, things like that, that you can trade, probably computers which are programmed appropriately, and now he has hundreds and hundreds of math PhDs running and working at the firms called Renaissance. You can probably outperform humans. So he kind of invented that business, and it's done quite well. So to summarize, I interviewed a number of people, and in the end, I came up with a number of rules from them about what it means to be a great investor. But for the average investor, let me conclude before I take some questions. What is the average investor? So, well, if you're an average investor, and you're going to do these things yourself. You're basically going to try to do deals yourself and buy real estate yourself or buy stocks yourself or buy bonds yourself and basically do it yourself, learn it yourself, maybe as a full-time job or maybe as an avocation. The things I would say are, one, don't think you're a genius. If you're great at making widgets, you're probably not going to be necessarily great at investing. Secondly, don't risk more than you can afford to lose. So if you start with X dollars and don't think you're going to double it by taking a big risk, and so be very cautious. Three, diversify. Don't put all your eggs in one basket, obviously. Also, be realistic in what your expectations of your rate of return are going to be. If you're a non-professional investor, trying to get 20% annualized rates of return, in my view, is probably a fool's errand if you're not a professional investor, because one of the problems with investing is it's like going to Las Vegas and gambling. If you do well in your first deal, you'll think, hey, I am a genius. George Soros is not smarter than me. Warren Buffett's not smarter than me. I should have been a full-time investor. And you double down, you triple down, just like you do in Las Vegas, and you walk home with no money. And that's a problem that many people get when they get lucky on a first investment or so. But don't put all your eggs in one basket. Don't try to get unrealistic rates of return. Read as much as you can about something. Ask as much as you can about something. Work with other people that know what they're doing, and put time into it and make sure you understand what you're really getting into. Now, most people here probably are investing, if you're investing, are in funds. So you might say, I'm going to invest in a Carlyle fund, a Blackstone fund, or a Sequoia fund, or a Vanguard fund or something. Whatever funds you're investing in where other people are doing the day-to-day work, these are the rules I urge you to consider. One, look at the track record, because the track record is the best indicator of future performance. Not a perfect guarantee, but good track record is important. Make sure the track record was in an area that is still relevant. If you're a great investor in buggy whips, but then the automobiles are coming along, having somebody that knows how to invest in buggy whips is not as good as somebody who knows where the future is going. Make sure the people that made that track record are still there. Very often people produce great track records, and the people that did it, they left and start their own fund. Make sure that the people that are running the fund and the senior people, if they're still there, are putting a significant percentage of their own money alongside you. Make sure the younger people are getting a piece of the profits, because if they're not getting a piece of the profits, they're going to leave the firm. Make sure that this is, you have other smart investors. Smart money knows how to find good funds and good opportunities. If you were asking, you should have the right to ask for who the other investors are, and if nobody you've ever heard of before, be careful, because smart people are going to figure out how to get into good funds. If nobody's you ever heard of going to your fund that you're going into, might not be a good thing. Also, make certain that the organization doesn't have a reputation for fraudulent behavior, or isn't getting sued all the time for having misled investors, because you'll be surprised when you do checks on how many firms actually get sued a lot for fraud. Make sure also that you can understand what the fees are. The fees are not easy to understand for everybody. You have to make sure you understand what the fees are. Make sure that you can get access to information about how the fund is performing on a regular basis. And you can, whenever you need information, you get it, and you certainly get it regularly on a quarterly basis, but if you need in between, there's somebody you can talk to, can tell you what they're really doing. And also make certain that the people running the fund have your interest at heart rather than their interest at heart. Because very often funds sometimes are run for the benefit of the people who are running the funds, not so much the investors. And so when you're looking at funds, be very careful. But in the end, my final advice is, investing can be a very enjoyable thing. If you're a professional investor, you can be obsessed with it like you can with any other profession. But and if you're not a professional investor doing it full time, and you're doing it part time, or you're doing it with the help of others, just make sure you really know what you're getting into. Make sure you're realistic in terms of your expectations. Make sure that you have a grounding on what you're doing. You read as much as you can, and you're not trying to replicate Warren Buffett or Jim Simons, because that's very difficult to do. But anyway, let me end there and say I'm happy to take questions in the time. Yes, there's one back here. Okay?
Great presentation. The one area of alternative investment you didn't touch on were NFTs. Can you speak a minute to that?
Okay. NFTs, yeah, I didn't get into that because I didn't have time, but NFTs, they may be the wave of the future. I can't rule it out. Like anything that's new, there's going to be some that are going to be fraudulent. Some people don't know what they're doing. I do think it's not impossible in the future. People might say, look, I don't need to own a famous work of art. I'll just own a little fraction of it because I'm just put it on a computer screen. It'll be in my house it's the same thing. So rather than showing the original de Kooning, if you have a fractional interest in a de Kooning and you show it on a computer screen, maybe in the future it will be seen as valuable. I wouldn't rule it out, but know what you're doing and don't think you're going to get rich quickly in it, and just be cautious. That's my main view. Just make sure you know what you're doing, but I wouldn't rule it out as an asset category in the future. I do think it's possible. I should have said, by the way, investing is not something that you should look at people that are investors, any of you are investors, and say, oh, they're just greedy people trying to make money. Well, the truth is, professional investors, sure, their goal is to make money. But in the end, I think they're helping the economy. I think they're actually helping companies. Why is our country so strong? Many reasons. But I think that we have a very good economic and financial base, and that's been based on good investing over many years, giving entrepreneurs money, giving companies money to restructure themselves. So I don't think people should look at themselves and say, I'm an investor, I'm a greedy person, I'm not helping the country. My view is if you're an investor and you're very good and you're investing other people's money alongside you, you're actually helping the country. So it shouldn't be something you see as less important than doing other important things that might help our country. Okay, yes, sir, Stuart.
David, we all admire your success and how you've given and helped others. How do you handle the downturns, the cycles?
What is a downturn? Well, look, I should have mentioned that the greatest fortunes are made often in the downturns. I've asked people on my TV show, I always ask people, what's the greatest investment advice you ever got, and what's the biggest mistake investors typically make? The biggest mistake that average investors make is they get out of the market when the market's going down, and they come into the market when the market's going up. So it should be the opposite in many ways. When the markets are going down, it's almost impossible to figure out what the bottom is. You're never going to hit the bottom perfectly. But when the markets are going down, that's a time when I think it's a good time to invest. And you shouldn't get afraid of things if you know what you're doing. So right now, the market, we're in a bear market. A bear market is defined as 20% down from the top, more or less, and we're more or less down 20%. But cycles come and go, and the markets will always come back. Markets always fluctuate. I don't think we're going into a great recession or a depression. We may go into a modest recession, but so what? Prices will be down a little bit. Maybe you don't get the bottom of the market, but now is probably a pretty good time to invest. Now, my own stock, Carlyle stock, is now down. I think we peaked at 61. We're probably at 31 today or something. So we lost half of the market value. Blackstone's lost. Blackstone, I think, was a similar firm, much bigger than ours. Blackstone stock, I think, was at 160. Their day at maybe at 90. So we've all lost half our market value or more. And it's no reason to panic because now prices are cheaper and probably more sensible. So assuming you have the courage of your convictions, you know what you're doing, now is probably a pretty good time to invest. So sure, you get a little depressed when you realize something you thought was worth X is now worth half of X. But you can get over that after a while, I guess. So my mother was alive. She used to call me and say, well, David, your stock is down. I mean, you have enough money to pay the rent and everything. And so I'd say yes. She was getting nervous that the market would go down. But assuming you have enough money to pay the rent and so forth, I think times when things are like this is probably a pretty good time to invest if you know what you're doing and you're really careful and cautious about what you're doing. Like the real estate business cold, right? So if a real estate deal comes along today, now's probably a pretty good time to get into real estate because prices are down a bit from where they were. So I wouldn't be cautious about it myself. Yes, sir.
In your interviews, did you speak with angel investors? And if you did, what did you learn from them?
I didn't really because the problem is this. I interviewed a lot of people, and then the embarrassing thing is the publisher said, well, we only have a certain amount of time, space, so I couldn't put everybody in the book. So it's very awkward when you interview somebody and then you say, well, thanks for the interview, but can't make it in the book. So I put a few of them in the audio version of the book. Maybe they'll be upset they didn't make this version. I did interview a few angel investors, and I didn't put them in the book because it was too esoteric a category for this purpose. But I think angel investing, and my son is now an angel investor. I backed him. We'll see whether that works out. But he went to Stanford Law School, Stanford Business School, and he's got some good partners, and they're doing angel investing. Angel investing is very, very high risk, high return, as you know. So the most famous angel investor I didn't interview him. Ron Conway, maybe one of the most successful. He did Google and other things like that. But angel investing is not for the faint of heart, and you'll probably lose money on 9 out of 10 deals, maybe on 90 out of 100 deals, because it's just very risky. And for those who don't know, angel investing is when you give money to somebody who has got a concept. He or she doesn't have any revenue, have earnings, they have no customers, they have nothing but a concept, but they want to get a company off the ground. And so when the Google boys were raising their initial money, I think Ron Conway gave them some, and a few other people gave them money, and it turned out to be great. But it happens rarely. After angel investing, you go to early stage venture investing, where you're going to somebody maybe has some revenue at that point, and maybe even earnings or so. But angel investing is, I didn't put it in. I think it's for people that really, really know what they're doing or really are well connected. And two of the best angel investors. One of the best angel investors in recent time was Mark Andreessen. When Mark Andreessen sold his company, he got a lot of money, and he started doing angel investing in Silicon Valley, and he backed, among other companies, Facebook, which he's been on the board of for a long time. Benny, I didn't have a specific thing on angel investor. Are you an angel investor? Yeah, it's not easy, right? No. Gary?
Hi. First off, you are a great investor. I have firsthand knowledge of that. Okay, I want to ask you about a topic that's hot today: work from work versus work from home. Work from work versus. So you talked about a bunch of folks who mentored others and who were mentees, and they learned a lot and they became great.
Right.
How can you do that in a situation where everyone's working from home?
Okay. In the financial services world, you may have observed that more of the CEOs are saying, "Come on back." David Solomon at Goldman Sachs say, "We want you in the office." Jamie Dimon at JP Morgan, "We want you in the office." Why are they doing that? Well, they're doing it because it's the general view that in the financial service world and the investing world, you really learn by mentorship. And it's easier to mentor somebody if you can go to lunch or breakfast or dinner with them, or you can interact with them socially in a different way, or in an office. And when you're remote, it's hard to get mentoring. And so a lot of these people are afraid, the CEOs, that these young people aren't going to mature at the level and the rate that they should, and therefore they'll have a missing class. I do think that in our firm now, we say basically we like you in the office 3 out of 5 days a week if possible. We don't do bed checks and so forth, but we think it's better to have people in the office. And I think probably work has changed to the point where probably very few people are going to be in the office 5 days a week. All the time. They're going to work remotely a bit. I don't think that's a terrible thing, but I think if you need mentorship, as I think young people do, you really should work in some of these places not so remotely and be in the office as much as you can. And that's what I think is much, much better. Okay, yes? Go ahead, I can hear you. Go ahead.
Thank you. How do you think this period of high inflation is different or similar to the 70s and 80s? And how high will rates go? How much does the Fed have to do when they may not be able to control supply chains and energy?
Okay. Well, as I said, I'm an expert on inflation. The inflation in the 1970s was different for this reason. In the 1970s, 25% of the workforce in the United States was unionized. Today, it's maybe 10%. So less union pushing up wages. You could argue that maybe they should push them up, but we're less unionized. Secondly, we are less dependent on foreign oil than we were in the 70s. In the 70s, we imported massive amounts of foreign oil. We more or less are energy self-sufficient today. The United States consumes roughly 20 million barrels of oil a day. We produce 12 million barrels of oil a day, but we produce equivalents through liquid natural gas and other things so that we basically are self-sufficient. So we're not as dependent on oil prices, though when oil prices go up, obviously the prices here go up. But I'd say in the economy in the 1970s was much more a domestic economy in this sense. We didn't import things from China. We weren't importing so many products. We mostly produced things or had the services here. Now it's a global economy, so it's different in that sense. In terms of the Fed, Jay Powell worked for me. I hired him after he left government. He worked for me for 7 or 8 years. Very nice guy. He left the firm to do something else, he said, and next thing I know, he's chairman of the Federal Reserve Board. Glenn Youngkin worked for me for 25 years, and next thing I know, he's running for president of the United States. He's governor of Virginia now. So you never know who's going to leave a private equity firm and do something important. But Jay Powell has a difficult mission. He admitted he misread inflation. It wasn't transitory. today, the dilemma is this. Since the 1960s, I'd say, the Fed has increased interest rates 9 times, I believe, in an effort to reduce inflation, and in 8 of those times, it produced a recession of some type or another. Very rarely do you get a soft landing. So now the Fed's situation is you have inflation at record highs since the 1970s. If they don't increase by 75 basis points every FOMC meeting, people will think they're not serious about it. But if they increase it too much, and ultimately you're going to get higher unemployment. I think the Fed is prepared to have unemployment go higher than it is today because it's relatively low, 3.6%. I think the Fed won't say this publicly, but they could live with 4.5% unemployment. And if they get inflation under control, I think they would be better. But I think what Paul Volcker told us all was once inflation gets to the system, it doesn't get out of the system so easily. It can take years to get out of the system. Remember what Paul Volcker did is he increased interest rates 200 basis points over one weekend, and then he increased it later on. He did massive amounts of increasing of interest rates, and we haven't quite seen that kind of shock. And the reason we haven't seen it is in the old days, the Federal Reserve never told you what they were doing in advance, and they never told you what they did after they did it. You had to figure it out. Now they tell us what they're going to do before they do it. They tell us exactly what they did right after they did it. It's a little different, more transparent. But I would say we're going to live with inflation of about 5% or so for another couple of years or so would be my guess.
How are they going to bring down?
I'm sorry?
How are they going to bring down global inflation?
Well, global inflation is different. I don't think there's any perfect way of reducing global inflation. The U.S. is a big factor, but you're seeing now interest rates in Europe are going to go up, and that'll probably produce some reduction in inflation. But I think the biggest causes of inflation right now, I think, are oil prices because of the war in Ukraine. That's a major factor. And also in China is going to have some economic challenges probably, and that could produce some global inflation as well. But I see I'm being told I got to get out of here, so we're out of time. So let me say I thank you very much. And in the end, you can learn everything you want to know about investing in this book. Thanks a lot.